What China just did may have eliminated the chances of a US recession, paving the way for a soft landing and setting the stage for an end-of-the-year Santa Claus rally for markets. The People's Bank of China is the equivalent to the US Federal Reserve, and they plan to inject the equivalent of 140 billion US dollars into their financial system. We're talking stimulus checks to the poor, rate cuts on borrowing for property, small and big businesses, and consumer credit. They're actually sending money to financial institutions and telling them to buy Chinese stocks. China is manually halting the decline of their property market, their economy, and their stock market. And this marks the most aggressive economic easing since the global pandemic. And naturally, Chinese stocks are absolutely ripping. Meanwhile, the Saudis are walking back their $100 per barrel price target on oil, which means an increase in production to gain back market share, more supply, lower oil prices. Since oil prices lead gasoline prices, we can expect average prices a little lower. Now looking at the US, Bank of America reports seeing the largest equity inflow since October of 2022, with utilities receiving record inflows, up 25% on the year, driven by electricity demand from the AI build-out for data centers. Utilities are being led by Constellation Energy and Vistra Corporation, up over 50% in September alone. Now, since the Fed started cutting September 18th, investors are showing more interest in cyclical growth assets associated to an economic acceleration. Materials up 23% on the year, led by Freeport-McMoRan, a copper miner who just jumped 25%. Industrials being led by Caterpillar, consumer discretionary led by Tesla, semiconductors led by Intel and Micron, and the biggest outperformer of the S&P since the Fed cut, Bitcoin. Now the S&P is already up 20% on the year, but these gains will likely accelerate as the Fed continues the cutting cycle, and this depends on how the economy performs. The amount of people filing for unemployment peaked in July and has fallen ever since. So the labor market is slowing but not breaking. Why does this matter? Because jobs drive consumption and consumption drives the US economy. Mortgage refinancing is surging as mortgage rates hit a 2-year low, and Q3 GDP estimates are hovering around 3%, indicating the economy is far from recession. U.S. money supply growth is accelerating, suggesting a boost in markets and economic activity. A typical recession involves policy tightening, a drain in liquidity, and markets decline as growth rolls over. However, that's just not what we're seeing today. Markets are raging higher because growth is stabilizing, and with policy already easing and rising liquidity, we can expect markets to strengthen as they look forward to the easing cycle to revive economic momentum. And now that China is exerting massive stimulus along with the Fed cutting rates, the two largest economies are pumping more liquidity, which basically puts a bottom on everything.